None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. It is Friday. Short week, even feels shorter, I guess.
Yeah.
So pretty amazing, 142,000 jobs. Mitch and I were talking offline, the most hilarious thing to watch if you happen to have CNBC on, and how every economist had predicted 225 plus. One lady was there, 277, she predicted. I don't believe it. I just don't believe it. This isn't true. They're going to revise it. And the market's up 61 cents now after being down about 10 handles earlier. So evidently somebody bought into that whole story. Although I would tell you, after trading these numbers for many, many years on the trading floor and other places, is that it's always typical to fade whatever the initial reaction is. So if it would have been higher, you would have saw sellers come in. And this morning we were lower, so we are up a whopping 63 cents. And for whatever reason, this 2,000 number is just making me sick. I'm telling you.
We haven't gone anywhere away from it.
I know. It's like
2,000. This is like the market said, I'm done. We're just going to stay right here.
Yeah, and they're trying to get it right back there again. And yesterday was an interesting day. So today becomes a pretty interesting day when a significant day from that standpoint, because what we're going to have is we're going to need a lower close to confirm yesterday's reversal. And we'll talk about that when I get into the technical parts of this. But best I can tell, for the most part, I'm believing the number. I decided to believe it. Maybe that's my what were we talking about? Confirmation bias.
Confirmation bias, yeah.
So
well, it's funny because some of the talking heads out there, they wanted to spend more time talking about how often August numbers get updated and all this.
So why didn't they talk about that yesterday when they were predicting 225? Why didn't they say, you know what, we're probably going to miss because this is a weak number? It's just funny. It's like watching any media that you see that has a bias. It's when the market reversed, we printed the 2011, I think 17 high yesterday. Market went straight down all day, all the way down to around 94 and change, and then closed 97. And I happen to I don't have the sound on much on CNBC. I always say it's okay to watch it as long as you have the sound off. And you might believe something you hear, and they always have both sides of the equation, so they're just trying to appeal to everyone. But I turned it on, and they were, well, yeah, it's going down, but we're still near the highs, and we made a new high today. So it's the talking points and the media, and there's a bias out there. They want this market to stay up, and I was watching some of Europe last night. It's very interesting. I don't know if you guys, I wish there was a way, maybe you can put it in DVR and record it. You should watch a show or two a week of Squawk Box Europe. And the contrast is different. All we have on, we turn on CNBC right now, is one mutual fund salesman after another. I think the guy from LPL, sorry if I'm offending any LPL guys, I know we have a lot of you out there, but I mean, he called it a clunker. It's like, I'm going to dismiss it, it's just a clunker. And I don't know. These numbers are very volatile, but from my viewpoint, they'll point to numbers that came out a couple of days. I'm talking to markets keep rallying, but that's okay. But the point is that it's the bias and the sentiment that gets affected here. And the reason why, from talking points when we start off this morning, I think it's important to understand the market sentiment. And market sentiment is still positive, and that's what you're hearing. And as we go through the technicals, there's still technical elements out there that are still positive. We talked about this on Monday's show. So that's what you're seeing is that market sentiment talking, and it's I don't know. I just want to see something other. I'd like to see something other than 2000. Everything I'm going to go through in a minute is going to talk about some of the bias that I see as far as the technicals go, and they tend to play out eventually, and as long as things don't improve. And what we're seeing is a lot of deterioration. So was there?
Yeah, one of the things I was going to add to that, when you look at all these different economic reports, I forgot where I'd read it, but someone had I think really just nailed it on the head, saying that a lot of these sentiment reports, those are all the things that are coming out that are positive. Everybody feels good about the market,
right,
but when you actually look at the real numbers, what has taken place, those tell a completely different story. And so it's this lag as far as we're finally getting back to a point economically where things have gotten a lot better, certainly from where they were in the great crash. But when you really look at where we're at now at this point and going forward, things are really beginning to degrade quickly, or they're not speeding up as much as they would like to see.
Yep.
And so they finally feel better because they've forgotten what it used to feel like. And so the feelings aren't matching up with the actual facts.
It's like watching a gymnastics tournament. It's all judged, and anything that's judged, I hate sometimes boxing, because anything that's judged by people's opinions is always got some sort of bias of some sort, and that's what we're seeing. And that's a good point, Mitch, because a lot of these surveys are just that. So enough about this, but I think it's significant because there is a deterioration going on, and now the market's up $1.43, but that's okay. Let's go ahead and take a look at the technicals here, and start to look at exactly what is going on. And this is more revealing than all of the noise that we just spent 8 minutes talking about, 6 minutes anyway, is really what's happening in the patterns on the chart. So while the talking heads are saying what they're saying, even though the market's up $1.20 here after being down lower, I mean, we've still had a 9-point range today. And I talked about in commentary that the VPM rangefinder is now at 13.68. So we are, in spite of this big news that we all waited for all week, we're seeing a contraction yet of the volatility as we come in. So, dog days would be nice to get out. We're at 1368. We're pretty close to an average. We're probably closer to around between 15 and 17 is a typical range where you're getting enough activity in the markets that there's a way to determine better from a technical standpoint. When you get these narrow technical, ranges where they're very small, they have less of a predictability. And doing any type of quantitative analysis, doing any type of technical analysis, it's important to understand what the sampling is and what's normal in a sampling, and whether it's an outlier below normal or above normal, and it starts to help you to understand the numbers. Right now, we have seen these numbers, like I said, closed at, I remember 2000. The first close over was 2002, and then it was 12, and then we went up to 2003, and it's just waffling around this number. But meanwhile, the 3-day indicator got down to, I think, 638 was the low. I don't have the number right in front of me, but it sticks in my head. And as Mitch knows, those numbers stick. I've had to, back in the day when we didn't have computers and handheld devices, we had to remember everything. So I guess the memory is a thing of the past as well. But the bottom line is we had to keep all these numbers in our head. But I'm pretty sure 638 was the number. And when you start to get that low, there's just no predictability for direction for tomorrow or anything. If I was in Vegas, they would call me a card counter. I'm always counting bars in the pattern, And when you start to get these really contracted, very narrow ranges, there's just no predictability. And anybody that does any quantitative analysis understands the term predictability means that it, because of this, if the sampling's of a normal type situation, and that's sort of what these guys are playing off of on The Economist, is that this number that came out today maybe is an outlier, maybe it will get revised up. But the thing that they didn't talk about, there were 28,000 jobs removed from the last two reports. So when you get down to it, it was a $1.18 on this number. It was a really bad number. So even if they revise it up 50, I don't think they make it look good next month. And we'll see. Next month we'll have a lot to do. And I think we're continuing to see these type of things happen. So looking at data, whether it's daily bar ranges, weekly bar ranges, and those type of things, the predictability is much better right now on a weekly and the monthly graphs than it is on the dailies because of this contracted short-term range. And so looking at this chart here, you'll see that PPM, let me bring up the stats here, that PPM, get it up here. Where is it? No, I don't have this. I got to do something real quick, folks. I apologize. I thought I had this all set up. I came in this morning, one of my screens for the studio wouldn't even light up. So it was one of those crisis managements, like nothing changed, but something changed to the point of you can't. Anyway, you can't get it going. Anyway, so the numbers are 0.03 on the PPM1 on a daily. So this thing is flat. We closed under the average yesterday. The average for today is, let me get to the right place here, is 1998.57. So a close under there, we're trading 1998.44. A second close under there. And what I'd like to see, because yesterday we had what's considered to be an outside reversal bar. Let me just cover this again. I know I've talked about them. Those of you who aren't on the show all the time, you need to understand this. So an outside bar is where we made a higher high than the previous day and a lower low. And if we close in the lower 60% of range, which we did yesterday, it becomes a reversal bar. And an outside reversal bar that also occurs at a historical high or the top of a run, or it could be inverse at the bottom of a run, is significant, but only today. If it closes lower today, it will confirm that reversal, and then there's at least a 3 to 5 day decline that will come out of this particular pattern. And as I talked about just a few minutes ago, when you look at we'll go through this in a second, the weekly and monthly strategies charts, you're going to see that there's still some bias to the upside, and that's reflected in the sentiment as well, and that's why the markets are trading slightly higher right now. So so as we look at this, PPM 2 is interesting because if you look at the right hand side here, you'll see it's actually accelerating. So the 21 period moving average is starting to pick up. That value is just under the market, which you'll see is 1975. It's changing roughly by about 4 points a day. So around 1979 is the magic number there. And typically what will happen here is you'll see that the market will come down and the price, the low day, one of the lows of the next couple days will meet the price of that 21 period moving average. And when it does, we should get a bounce off there. They'll retest the highs. If we don't make a new high on that, then we're going down all the way down to some of the numbers I talked about in commentary last night, which are I'm just looking at my sheets here, for the market to go down probably toward the 1983.95 to 1981 number. That would be not a big decline actually anymore. That's just probably a less than 2%. But the bottom line is that would put us down to support levels, and then there's some key levels below that will be pretty important to the shorter term trends and then also start to affect the intermediate trends. So let's go ahead and look at the weekly graph here. This graph here is, let me just give you a little perspective here. This goes all the way back to 09. Now that in the middle of the page, this is the 09 lows. And as you see what's going on here, we have PPM 1 at 0.19 now, which is below trend level. That number that we're looking at is also 1971. It's interesting, and I've talked about this many times, it tends that the 10-week moving average is very similar to the 10-day or 40-day moving average. And as we go up the scale, you'll see some other correlations here. Now we just upticked a little bit. We're trading right now between 19 and 20 on PPM1. It's trying to uptick. 25 or better is a trend. Right now we're just below trend level. 45 on PPM2 and 26 on PPM3. So we still have underlying trend that is showing trend characteristics, which tells us, and not like we referred to, what you're hearing is the market sentiment talking. It's also reflected from a technical standpoint that there's still an underlying bias. Those support points off of those numbers are a little ways down. As I expand out this graph just a little bit here, you're looking at those values are quite a bit down. Where the PPM or the 21 period moving average is 1938. It's currently jumping at, it's jumping about 9 points per week. So that's going to be in the mid 40s coming up this week. And then the PPM, it's interesting that while the PPM3 is in trend mode from a number standpoint, 0.2568, when you look at it from the indicator standpoint over here, you see that it's below its first and second derivatives, which is usually a bad sign. There's a mix going on here, and this is pretty typical. Going to the monthly graph, which I discussed on Monday, we are seeing numbers that are indicating we're not quite there. I'm anxious to see what happens on the first tick of Monday. What happens if we can get through here. So we're at 102 on the indicator right now on the PPM1. And I've talked about this. When this gets below 0.1, so 0.99 anything, we're already seeing the characteristics of a very substantial top beginning to form. Doesn't mean there could still be some numbers up around the 2034. There was a number that was talked about going way back. I'd have to dig back in the archives maybe 2 months ago. There were some patterns that were set up that were suggesting the 2070 level. But right now, these trends are still positive. At 1.02 is still a positive trend, and that is currently around the. Let me bring this up and see this a little better. You look at the values of this. 1906 is the 10-month moving average. If you recall, last month's low was 1904 and change. I think 1904.70. And that is exactly where the market, where the support is now based on this. And we have a PPM that's well over 0.25. It's at 1.02. So if the market were to get down there, chances of it going below that would be pretty minimal, probably less than 10%. And the point is that what we're in here, we're still in an uptrend. Market has not rolled over yet, but what it is doing is the PPM1 is running much slower than the PPM2 at 157. You can see down below here 157, then 106 on the PPM3, and that is the prescription for what a top looks like. We can go back and we've done this on other shows, but if you look at the 2008 top, this is exactly what happened. And Mitch brought up a point, and they're spread out so much. The other day we were talking about this. I'm not sure if it was a week ago or when it happened, but there was a discussion that came out. And what happens, because of the moving averages are spread out more, the probability, the next moving average in the sequence below 1906, so when this level is penetrated, you're looking at 1763, and that's a bigger number. That's a couple hundred points on the S&P, and so that number is moving up. So it may end up around the 1800 level over the next, let's say, 2 months or so. But that number will be tested at some point, and because of the way they're spread out, it gives a little more downside risk before support will come into play. And meanwhile, while all this is happening behind the curtain, if you look at what's going on with a lot of stocks, and even today, just some major names out there, the energy's getting beat up. You're seeing flow into some utilities, so there's been a defensive posture starting to show up. We talked about that on Monday as we went through the VPM database, what was being bought, and we're seeing some flow and some new trends starting to flow into these other areas. And from the standpoint of what's going on here, this tells me that this process has started. We're at the final section, and it could take anywhere from 4 to 6 months to finally get a serious rollover in this market. And it would take some kind of shock wave to blast it through 1906 right now, and that the probabilities right now are very low that we would go below that. So while we're stuck around 2000, we may be stuck between 1900 and 2000 and change for a while, maybe for at least another 4 to 6 weeks, and we'll have to see how it goes. So hopefully it doesn't get too boring. We're trying to come up with a schedule for next week and how we're going to handle moving forward with the show, because there's other elements that we want to bring in. We did Process Warriors before, and we're going to maybe do a combination of market and Process Warriors. Haven't decided yet, so we're working on that. Some feedback from you folks would be really helpful. So anyway, but this pattern that is setting up here continues to be, in my opinion, the beginnings of a major top, not a minor top, but a major top. This is the way it happened in 2000, and actually I can go back to 1998, 98, 2000, 08, we'll call it 7 and 8, when that top formed, this section here that's in the middle of the page right now, and now we're going to start this next phase. I know there's lots of folks out there think this market's going up forever because the central banks are going to drive it up, and that's probably not going to be the case. There are some elements out there happening. So let's switch over and let's go and look at, I'm going to run through treasuries. I think there's some interesting things happening there. There's some key points on treasuries that we can look at. And we've got to, I'm going to change the scale real quick because it's kind of hard to see right at the moment. So let me change that. And that was somewhat helpful. But what we've got, this downtrend that we've had in treasuries is still in place. We have a PPM1 at, I'm in front of these numbers, so I'll just read them off. PPM1 at 113 minus 71, and minus 38. All three of the moving averages suggest that we are in a downtrend on rates. So the fear of a lot of upside on rates is minimal, I believe, at this time. And if I go back and put this scale back a little bit like I had it, I want to look at the real short-term movement, look at the daily movement. And you can see here, it's also just waffling around these moving averages here. We see some positive movement on the PPM1, but for the most part, we're not seeing anything significant, although it's more of a bottoming pattern than it is of a continuation pattern. So on a short-term basis, on an intermediate, there's still a lot of overhead resistance. 245 is a big number, 252 and all the way back up to 268 is the big number. So we've got a lot of movement that can happen in treasuries and not make a lot of difference. And I believe, Mitch, maybe you can help me out here. Didn't we see a pickup in some of the areas in the bonds last week? And do you recall?
Yeah, it may have been a week or two ago. Let me pull that up and do some digging, and I'll follow up with you.
Yeah, so I got you on screen, so we'll watch you dig. But the bottom line is, there has been some movement in our database, and it's not always about Treasury. Everybody's looking for this yield, right? So you got Europe going on you've actually seen. I wish I had a chart of the Bund. I'll have to see if I can get that on. I have international access. I just haven't dug into that enough. But there has been an increase in yields. It got down to 0.89. I think it's pushing back at around 0.98 again. But and you're looking at negative yields, and I guess the funny part of everything that's happening out there is they're trying to force people. You actually have to pay the bank to get money, and there was a conversation on CNBC last night, and they have much more interesting guests, at least guests with real opinions that are about markets, not about who they work for, and the whole discussion is, can negative rates actually cause banks to start to lend, but and make people want to do things? And the whole European scene, talking about sentiment, I saw a report that somebody brought up that supposedly the Germans, who are in the best position, the German people are having trouble sleeping at night because of QE and all this stuff. They're scared. So nobody's spending any money, nobody's borrowing money, and even if the banks want to lend the money, nobody wants to play. And after the years and years now, after the financial crisis and the credit crisis, we're still seeing the reluctance of all of us to borrow money. I'm building a new house. I'm not borrowing money because I don't want it. I'm too old for that stuff. But the bottom line is, that's the mentality of a lot of folks. If you look at the home sales that are going on, there are a lot of cash deals going down. Whether they're investor types or whatever, nobody's taking on debt to buy homes right now. And there is some activity there. It certainly has shown some stabilization, but it's nothing like it. There's just not. It's not even the fact that the industry's not ready for the next move up from a housing standpoint. It's the fact that nobody really wants to buy or borrow money right now, and unfortunately, a lot of the millennials already have a mortgage. They just don't have a house. They've got a debt from their student loans and everything else. So they've already got more debt than they want, and it's easier to rent and not take care of anything. So needs some social shifts to actually get some players, and the millennials are driving a lot of stuff right now. And so what'd you find out, Mitch?
I'm just trying to see when it was that we had that large tranche of bonds. It's been a while now that I'm going through the different reports. We've been
well, not so much a large tranche, but we saw last week, I believe, some movement in some of the areas in the bonds. Not a lot, but we saw some utilities came on, and it seemed like there was some other activity just last week that I was talking about. So
yeah, utilities and energy, I think, were where we saw the most activity last week.
Yeah, it's interesting. Utilities continued, or the energy was getting hammered yesterday. But anyway, the looking at the debt situation here, I still don't think there's a real risk in higher rates, and I think there's a tolerance level that is built into this market. So from looking at anything happening from the, I guess, rates causing anything to happen in the markets, probably not. We're now up 248 on the S&P. I'm looking at here 2013, and I'm going to flop over back to this chart so I can see what the high of the session's been. 2016 has been the high, and R1 today, or resistance 1, is 2090. We get through that number, then it's 2004 and so forth. So there's definitely still, like I said, there's still a bid out there, and we'll see what happens. So far we've traded our S2, which is 1980. I think the low was 1990-10. The 1990-80 was R2. Now we're trading at R1. Yesterday was actually pretty interesting. We traded the extreme at 2011, and then we traded all the way down to R3 or S3 on the downside, and then we settled just off of that. So certainly a little more pickup. We're now at 10 handles on the range. So as I said, the 3 days, 1368 is going to be normal. So we'd get up, if we did get through this 2090 level, there seems to be a little bit of a movement going on there. I'll bring up the webs here. You can kind of see what's going on the. I'm in the way, so I'm going to get off the screen here for a second, so we can take a look at this. But you can see we're 2 ticks off the highs, actually 1 tick off the high on the offer side, and so we're moved the futures all the way up, and they're printing where the highest they've been, and going back to the end of day or the hourly 24-hour charts here, you can see this. I mean, look at this thing here. I mean, this is like an EKG. It's not like there's no trend in this market other than short-term, maybe 18 to 24-hour trends that are even showing up here. And if we go to the shorter term, the 5-minute chart, you'll see, interesting enough, we had a cycle come in. The cycle was pretty good this earlier last night, and now we had a cycle come in. So it looks like whatever the next cycle coming in about an hour and a half from now will be a high cycle, and it'll all come down to the end of the session today, how people want to square up the books and where the market sentiment's going to drive that at that time. But from this standpoint, we had a really nice volume spike here. I've put a cursor on this right here, this big bar up. This is right at the employment numbers. This thing faded back, and then we basically triple bottom this pattern, and now we've taken out the high. We're now up. We're getting real close to that 2090 level right now. We're 2063. So, but these patterns that are unfolding here, just bring this hourly chart. You can just see these are 24-hour patterns. So this is overnight. This represents everything that's out there, and you can see it's just whipsawing back and forth. So, and here we are back in this range. The other thing I want to point out here is these ribbons that are on this page. Whenever they get above the market like this, you see on the way up here that market was trading in the ribbons. When I get out of these ribbons like this, it usually suggests there's a cap on this market. So regardless of the fact that we're now at 201.53, so we've gotten through the 2090 number, and we're seeing some momentum pick up on this rally, but we're coming into resistance points here again, and whether we get to 2004, if we get up to 2004.50, we're going to have about that 1360 range, and that's probably going to be about the end of the party when we get there. So not a lot from the standpoint of you can see this surge here on this chart over here on the right. You can see that surge, and when we go over to the webs here, we punch out new highs. There's not a lot of resistance right now until we get up to about 2150 or so. Over right above my head here, you can see these are offers that are in the system, and there's probably about 10,000 contracts above. It's not that big a deal. We traded just down here at this one price, 96.50. We traded 28,000. So once the volume starts to come in, then we can see it. This may have been somewhat climactic here. We're starting to see some of the bars roll over here on the 1 minute, and whether the key number is going to be about 2.5 handles lower. So that might have been most of the run right there. You'll see what I need to flash to another chart to be able to see the high of the session is 20,190, so 100 points over what was on the sheets last night. So from like I said, I think to summarize, the trend is up, and my old buddy Lou Horowitz, who used to be the head of the New York Futures Exchange, which is long gone, used to always say the trend's your friend, never too high to buy and never too low to sell. Lou used to always chant that all the time. He was a funny old guy. But the bottom line is, there are points when it gets too high to buy and too low to sell. But the point of this rally is it's continuation of what we've been seeing all week. There's nothing new here, even though we traded down to 1990. That was the lowest day in the pattern. And as it stands right now, which wouldn't surprise me at all from a technical standpoint, is this is the monthly graph. Let me just go back to the daily real quick here. but this chart is pretty much telling the story. We're right on what potential support from a momentum standpoint at this second derivative here on the PPM1. So we're right at a key point there from that standpoint, whether it holds or breaks through. If it breaks through, we're going to see some downside. We're going to see those numbers I talked about, somewhere between 1987 and 1981 traded down to. And regardless of the close today is everything from my viewpoint. So if we close lower, we're going to get a confirmation of yesterday's outside bar. If we close higher in the day, it's going to be neutral, which wouldn't surprise me, and we end up in a continuation of the pattern. So whatever the conversation, we'll have to see what's coming out. We'll see what the conversation around the economics and those type of things will be as this unfolds. But for now, today's close needs to be below what was the close yesterday? It was 97.65. We need to see a close below that level to really confirm any kind of continuation of weakness. Otherwise, we're still locked in the same pattern we've been in. Even though we saw the outside bar, that tells me that we'll trade sideways and we'll probably see a retest. I've talked about in commentary several times about a range on the upside of 2008 to 2012. So far, all of the resistance has been there. We've seen some pretty heavy selling once the market gets these higher levels. And I guess one of the things I was going to say earlier, the conversation in Europe is there's nowhere to put money. So anytime there's a dip, people keep coming back to the market because this seems to be the place where they can make any type of returns at all. You got to pay the banks to put cash in the bank, so you're going to put it somewhere else, and that's what they're trying to force to happen. And it's working right now, but it's not working very good. And I was shocked to see, at least initially, the futures when I was writing commentary last night. The futures coming into Europe were showing about 1/3% down, and I don't believe that's how they finished up there. So let me take a look here real quick. I'll tell you that where they finished up, and I believe they were kind of a mixed scene last night. Yeah, the Germans finished up 0.23, and everything else was down. The CAC Quran was down about 19.19%, so not a lot. So for all the enthusiasm we saw after Draghi's comments, they all seemed to dissipate pretty quickly. And I know we sold gold the other day, but I'm going to bring it up. So I think that's also, some of you still have a fair amount of this in your portfolios, which we let go the other day, which appears, at least for the moment, to be a good idea from that standpoint. I'm bringing up the weekly graph. We have been in this long since July. We're just been this sideways pattern. And I've talked before that had objectives around 1,400, and so those are, even though the pattern broke down enough, we held that gold position for quite some time. It was like, what, 6 or 8 months, Mitch, something like that?
Yeah, we bought in September 3rd of 2013, sold it last month on the 25th for a 9% loss.
Okay.
So almost a year that we held on to it. We had less than 1/3 of the downside of the total position over the last year. So
yeah. So from a technical standpoint, if we look at the PPMs here, and the result of that is getting off screen here, is you can see PPM1 is -2.1, so it's almost a downtrend there. It's minus 0.07 and then a plus 0.08. But if you look at the configuration, or how the slope of these things are, the PPM 2 and 3 are actually in a positive slope. So we're still have some underlying. This thing isn't going to collapse. I know there's people talking about 1050 and lower on gold. That may be in the cards, but for right now, the trends have been broken from the standpoint of holding a position, and that's why VPM let it go last week. There were some positive elements there, but in the end, we just didn't get the type of activity that we really needed to maintain the position. So I would tell you, though, even that last position was a loser, I would definitely make sure, if I have gold, make sure you do this next trade, because it's going to be, it's usually after a long hold like that and a long consolidation, the next trade is most likely going to be a good one. And certainly get your money back plus on that particular trade. I doubt if most positions that we have from a trade impact standpoint that you're even going to see much of that at all. So, Mitch, did you have some stocks and some other things we can go through today?
Yeah, what I wanted to do today, I wanted to go through some of the components of the all-weather ETF. So I thought it'd be good to go through essentially the look at the style boxes using the components in our all-weather ETF strategy.
Okay.
So let's start with, I guess we'll go with the S&P growth position. S&P 500, the RPG is the large cap growth. And this was the last position that we held on to from an equity point of view up until the middle of last month. We finally sold out of this position.
And what model was on that?
I'm sorry, 3.2.
Yeah, so I've got shorts turned on here. Let me turn that off. And by the way, good news. Mitch knows what I'm going to say. We're off screen, so you guys can't see us laughing right now and smiling anyway. The VPM Market Mind for TradeStation is completed. I have the files. They've been tested. We are now putting together the elements of so that you can start to look at some of these things here. And those of you that want to try the software, we'll be putting some details together for you. TradeStation will give you a trial and just a couple little things on that. TradeStation will give you a free trial. We'll give you a free trial so you can try it out, and we'll put the details out. In some cases, depending on service level, there might be some additional cases. In other cases, there are not. And so we're going to be putting all the release notes out, and we'll have a page to download the software and all of that, and we'll tell you the exact procedure to be done. But you can get the TradeStation software for free if you open a small trading account. I think it's $10,000 or greater. So that's probably the best way to go if you're doing some personal trading. It's pretty simple to get that approved. I know there's folks out there in the field that have known me that for a while that have also used TradeStation, so that's going to be easy for them to bring in this new logic when we get it all done. So anyway, just a quick note. I'm just so happy now. It's on our side, and I've been working on some of the elements, so we should have the ability to get this stuff out there. And when this is officially released, we will do a meeting just on that, so you folks we'll go through a demo and how this stuff works. There's a lot more that you can do with the TradeStation because it's real time, and because there's other indicators. We've broken out some of the process point stuff that's inside of VPM that you can also utilize for your advantage to make further analysis and better choices, especially when it comes to filtering any of the positions you have. And nice thing is we've had plenty of comments over the years. Gee, wish we could do a monthly trade so we could slow down the trading activity. Well, you'll be able to do that, and we're working on a couple things on how you can authenticate that in the combination of, I guess, Mitch, we could use VDOS web if we had to do some of this stuff.
Right.
But we'll come up with some ideas. There'll be some development on our stuff. It'll be real time as we develop some of these ideas. We're working on some things right now to help that out. Sorry to get on a segue there, but so going back and looking at RPG here, we're out of this trade. But also, if you look, and this was the growth, S&P growth, right?
Yep, the 500 growth.
Yeah, so if you look at the PPMs here, we are plus 3.6 on the short term, 4.6 and 3.9. But what's happened is because this thing has dropped below these levels, we don't have a position because of the actual pattern that's unfolding more so than what the momentum is, and that's a key element to understand. I know that we did some Process Warrior shows where we talked specifically about about some of how the decision process is happening in some of these patterns. And you have to remember, down here we bought low, we're selling high, and putting on positions when you're at historical highs is not usually not a great idea unless there's some great momentum boost that accelerates this market yet to another level. And not sure what that's going to be, especially when you're getting numbers like 140 minus 28 and so forth. We'll find out if those are real or not. I suspect that there was a big downtick, and there are elements there, whether it's 140 or 170, it's not 225, and it's definitely not optimistic 270s. It's funny how the market sentiment works, is everybody even believes or they don't believe, and then you start to get things like what we talked about Monday, Morgan Stanley talking about 3,000 now on the S&P. So it was kind of interesting. We were having a conversation with one of you yesterday, and the advisor pointed out that you couldn't find anybody who knew what the S&P is, and now everybody knows what the S&P is. It's like everybody knew what the Dow Jones is. Now it's just the awareness because of all the media, because of all the access that we have. There was a point in time in the day when I started in this business where we had all of the information. The clients had to call us to find out anything. That's been long gone for since the internet in the early 90s. That all changed. But this growth side is going to be one of the stronger elements. The large cap growth is definitely one of the elements. So what's next, Mitch?
Next up is I wanted to talk a little bit about the small cap side of things. So do the other extreme. We'll do RZG. So this is the small cap 600 growth. And that is on a 1-2. All the rest will be on the 1-2 weekly.
Okay. Let me switch that out. Okay. So as we've discussed on and on, there's been a big lagger, and in 2013 you can clearly see the big trend that occurred here on the small cap index. I'm going to bring up whiteboard here, but you can see here's the trend I'm talking about here. I'm drawing the arrow, and then we got out here, and since then we've been in this zigzagging pattern, and I'm willing to bet, based on all of this down here, that this next move is going to be down into these support projections. 70, 73, 69 range and it's currently at 79. So 10 points. That's about a 12% decline that would have to happen to get down to these numbers. Probably at the top number, we'll probably look at 6 or 8. And of course, we haven't had a 10% decline. I think everybody's going to be really disappointed when we do get 10% decline, because I don't think it stops there, and I think that it's a signal of something larger when that happens. But this is the pattern that's unfolding here. Momentum is flat at best, so there is no momentum on the upside, and we talked about this. The fact that you don't own some of these positions doesn't mean you're missing out, because these positions, if you owned them, aren't going anywhere. So it's the illusion of I guess the damage that was done psychologically by hanging around MPT and people that didn't believe you could time the market, is that somehow if you have any cash and you're missing out. It's not true, and there's no advantage of really allocating out to try to let's put everything into SPY right now and make it 80 or 90% long. And when you look at it, there was one little blip up, a couple percent, and since then, as we talked about in the session just earlier about the S&P, it's sideways. It's not really going anywhere. We printed 2011, we're back to 90, so we've got a 20 handle range right now that we've established with the highs of the at 2011 and the lows now at 1990 from this recent pattern. So we're starting to set the points where the markets are going to go there. And as we talk, we moved up to 2002.81. I'm not sure what the highs are here, but this particular pattern is exactly what we're seeing, is that there's only, and this was, I'm telling you, this was what happened in 2007 at the final high. Not all the indices were making new highs. When the S&P printed in November of 2007, the actual high print, that 1576 number, I think it was, when it printed that number, there were, the best I could tell, I went through all the indexes, there were fewer than 350 stocks driving every indice out there. So it was the top end of each one of the indices was driving the market. And of course, we know how 2008 started. The same thing is happening here. The participation is becoming less and less and less, and that's why VPM's at what 46% long right now, 46.80 something I think it is, and that's what we're seeing. So kind of babbling on about this, but Mitch, what's the next one? And this was the growth side of this. Can we look at the value side of?
Yeah, that's what I was going to do next.
Okay,
so
good.
The value side is RZV.
Okay.
For the small cap value, but it's the same type of pattern that we're seeing on the growth side in the case of the small cap. We got to the highs really at the beginning of this year, and then it's just been going sideways ever since the start of the year.
Yeah, so let's just draw out some of these things here. So you can see this was the trade here, April 13 into early January, and then since then, no trend, just sideways. I'm just drawing this out, and whether this thing continues, and this is the value side, and trying to find value at historical highs is an interesting thing. Mitch, we just reran the screens recently. Our screens was a value side. Was that the numbers down that you recall?
I don't recall offhand.
Would you look at that and pull that up? And because typically what will happen when the market gets really fair valued, the value screens become very lean. Otherwise, there's not very many stocks. I remember when we were doing a lot of the GARP strategy back in 2008 and probably through 11 and 12, we were looking at value at a reasonable price. That list got down to there were literally 8 stocks on the screen based on the criteria that we were screening for. So there was nothing basically to pick from to do that, and we had to be able to refresh those screens back at a point. We had to change some of the metrics there to attract more items into our list that we can take a look and filter, and that tends to happen when the markets get really, really fair. I guess at a fair value, it's hard to find value. So did you find anything yet, Mitch?
Yeah. So for example, the common sense value. Currently, we have. Let me just pull that up again. We have 16 stocks that passed that screen, and if you look back just a few months ago, it was up to 25, and then further back it was 26, 27. So this is a screen that has been slowly getting eroded away as far as the number of passing companies.
What does my favorite growth look like?
Let me pull that up.
I'm just kind of curious because even the growth side is going to get lean here from the standpoint of what's going on, because it's going to be harder and harder to find stocks that meet screens, and that tells you a lot about the character of the market. So when you start to tie everything together, your fundamental screening and all that, one of the things that a lot of you are missing out on by doing just trying to make just doing ETF strategies, what happens is you don't see what's going on when you're looking at baskets of stocks. So it's helpful to have at least one. We've always suggested that you guys have at least one equity strategy, even if you're running it just for yourself. The perspective you get from equities is much different than the perspective you're going to get from just looking at mutual funds and ETFs. There's just so much to be learned from digging into some of these screens and having a perspective. And I realize some of you have no interest in that, and that's fine. But there is a lot of perspective, and I think from my viewpoint, when I'm sitting down with one of you guys, or my clients, and if I had individual accounts, because I have such a depth of perspective, just a matter of communicating what's going on, what's doing, to let folks know that you have a handle on that. That's why we do this show, actually, to make sure that all that happens. So I've been babbling on. Let's do another one here real quick, Mitch.
Let's talk a little bit about the bond side. Let's do the ticker BSV. This is the Vanguard short-term bond ETF. Also on a 1.2 weekly.
Okay. BSV, right? BSV,
right.
Okay. Yeah, so looks just like the interest rate chart that we looked at a little bit ago.
Yeah.
Sideways mode, no up, no down. We actually have no Fibonacci projections right now. This is right here is the VPM projection tool and VPM price ratio, and we're just not seeing any kind of nothing out of here. And before this, all we're seeing is a bracketed, the ranges are bracketed, so there's not any movement up or down, which gives you no trends, no reason to own this thing whatsoever. I thought I had 1-2s on here. One of the things that happens with, I may not have enough data loaded up. I might need to load a little more data here to get.
Well, we haven't owned this position since 2011. So
well, that's why it's not showing up then,
that's
right?
why it's not showing up.
Okay, that makes total sense here. So I'm struggling, like, where's the trade? And
where's the data? Yeah, it's there.
It's got to be here somewhere. I must not have it, so I'm trying to cover myself, but thanks for that perspective. But the point is that there's no reason you can see to have owned this. It's even been declining or flat. And
right.
So once again, the whole VPM process, it's about owning things when they are trending. It's not buying the low, selling the high. It's about owning them, trying to capture that 60-80% middle trend, which it does a really good job. Sometimes it takes 2 trades to do it, and one of the trades may have bought higher than the other one. But if you look at let's say a 18-month trend, there's a good chance you're going to have 2 trades in that, especially if you have a 1.2 model running on it. You're probably going to have 2 trades in there. One of the trades may or may not buy lower than it sold the previous one, but when you add up the 2 profits that it made, you're going to end up with something greater than 60% of the trend captured. And that's all we're trying to do is, if you can capture 60% of the trends and miss out on the downside on these things, that's the formula for success. It's unrelated to what the indexes are doing in any window of time. But once again, if you start to, I call it a bridge. If you give me a bridge of 3 and 5 year windows to look at, this process is going to play out very positively, and especially when you start to look at a risk-adjusted viewpoint, it's going to do that. So we're down to the last 2 minutes, so I usually go back and review the charts and take a look at how these things are playing out here. So if we look here, you can see the markets have moved up. We're up 462 now, after being down about 9 handles plus. So we're getting closer to the 13, what did I say, the average 1368 range that we're getting as far as the volatility goes. And the bottom line is, this next cycle that comes in is probably going to be a high, which sets it up for the last hour making the decision on the markets. From the standpoint, it looks like we should have a high. Without bringing this up here, let me just see if I can't move it over here right now, but we should see a high coming out of this particular sequence that we rebounded, and this thing's going to pull back. Just a matter, do we stay over that 97.65 key number, close under that, confirms 3 to 5 days. You're going to hear about it in the commentary if that happens. If it doesn't happen, we got a trading range going, and now we've got it established. Probably most likely 1990 today's low versus the highs at 2011. That's going to be a 20 handle range. So Folks, have a great weekend. It's not as long as the last one, but we'll certainly have we'll be here on Monday to talk about what type of things came up. We'll have the benefits of the closing prices and things to look at. So thanks again for coming in. I know a lot of you are pretty regular watchers, and we really appreciate it. And as always, your feedback is gratefully wanted, and we need it bad. So we've been having the opportunity to talk to some of you that have been on the show a lot and gotten a lot of good feedback. So we need more. What do you want us to handle? All those kind of things. Anyway, have a great weekend. We hope that you will. We'll see you on Monday, and we'll see how all things play out when we get the run from the output of VPM tonight to see if there's actually any more increase in some of these trades that are coming out. Thanks again for coming, and we shall talk to you folks soon. Talk to you on Monday.